Okay, so we are going to do an exercise step by step where we have cells that have returns to. So in this exercise, we're going to apply what we just learned about the change and the mindset of how we account for revenue and income, because we are going to stop focusing on accrual and if it's paid or whatever, and we're going to focus on the transfer of control, and that's what really matters. That's the change, the deep change in accounting. So let's go step by step here. I have some of the information about the exercise. So in this example, we have a sale of 200 pairs of shoes, and the return policy says that the client can return the pair of shoes no more than 45 days. That's the amount or the length that the client has to make a return. And the price per pair is $80, and the cost of goods per pair is $40. And the company expects that there will be 10 returns. And this is something very important. During the first, and finally, during the first month, there are only 8 returns. So that's also something important. So let's start with doing the journal entries. And when we start doing this, I will pay special attention to certain things that are relevant. So let's imagine that this is the 1st of January when we make the sale. So the sale is 200 pair of shoes at $80. So we are going to account for account receivables, an asset, and the amount is $80 times 200. That's 16,000. And account receivable against sales, right? And on the same day, when we make the sale, we also have to account for the cost of goods sales. So cost of goods sold, and that will be $40 times 200, and that should be reflected on the inventory. Like it has make. But also we need to be careful because we need to understand what happens with the returns and what happens with the idea of transferring control. I think until here we shouldn't have any problem, right? It's only accounts receivable, sales, or even here it can be cash, and then cost of goods sold and inventory. But we need to think about what will happen with the returns. So during the first days, we shouldn't really do anything. We shouldn't care that much about their returns until the returns happen. And here it says that during the first 30 days, let's assume that on the day 30, the 30th of June, the returns happen. So on the last, well, let's make it 31. I'd like to make it easier. On the last day of January, 8 returns occur. So we need to account for those returns. Why we don't do this before? Why don't we make an allowance? This allowance is provision. Why don't we make an allowance first? Because we are in the same period, so it doesn't really matter. We have to wait until the end of the period to make an allowance, and that's actually what we are going to do. And why are we doing this? It's because during this period, during January, we transfer the control of the shoes to someone else, and we have the expectation or the forecast that maybe they will return it, but we don't know yet. So we are going to leave it like that. So the transfer of the control is done, but we are going to wait until the end of the month. And in the last day of the month, the client returns 8 pair of shoes. So let's make the journal entries for the returns. So the first thing that I need to account is sales return. Sales returns is the opposite of sales, right? You remember that when we in Spanish. So it will be $80 times 8, right? That's $80 per shoe times 8. And in here, we are going to account for the accounts receivable. We are not going to receive that. And we also need to account for the cost of goods sold. I always like to start with that. Cost of goods sold, it will be $40 times 8. And in here, we are going to impact the inventory, but normally we don't account or we don't register the same inventory. Sometimes we write down a new inventory of return goods. This will be 40, because 40 is the cost per pair. And this is the end of the month. So now we have to do something. Now we need to decide what to do with the other two returns that we are expecting. And here we need to think about the transfer of control. If we think about the steps that I told you, we need to we need to understand and we need to be conscious that the transfer of control finishes when you don't have any responsibility, when you don't, when you remember when, I think if I go back to the PowerPoint presentation really quick, I think I can show you that in the 5 steps, you need to associate each obligation with a price and then register the income each time that the obligation is fulfilled. So that's the last step until the obligation is fulfilled, until you don't have any responsibility. That's the last step of control transfer. So, oh, sorry, of transfer of control. So what happens in here in our exercise is that we can't account for an actual sale because we still have some responsibility. We are recognizing that it is very possible that the client will return 2 more pairs. So we need to do something. On the last day of January, when we are finishing the period, we need to account for the missing 2 returns. And how do we do that? Well, we need to, again, cancel the sales with sales returns, because that's what I'm saying. We need to mention that we are not done with the responsibility from that sale. It is possible that we won't receive it. And that is different. Instead of affecting directly to accounts receivable, we are going to make a new account. And I don't know if you are familiar with this account because this account is quite new, but we call it allowance on sales returns. So this is kind of a provision, but it's also part of that. It's, if you take a look at the financial statement, it will look like the sales, blah, blah, blah. Then you have sales returns, blah, blah, blah. And then you will also have this one, allowance on sales returns. This will also have some number. And these two numbers are negative, right? Because these are numbers that affect negatively the result. So it's quite similar. Sorry, not sorry, I was messing up. This is sales return for sales, but in accounts receivable, you have the same thing, but it is this one, allowance on sales returns. So it's very similar to sales returns, but this one affects accounts receivable. So this is like a negative asset, right? So it's like depreciation and all that. So this is accounts receivable, and then this one is allowance on sales is a negative account that affects accounts receivable. So it reduces accounts receivable. So we need, why don't we do it like here, that we actually affect accounts receivable? It's because it's not exactly the same. It's not exactly the same what we are doing in here. In here, we are kind of reporting that we still have some obligation for those 2 returns that haven't happened, but we can't do what we do with the ones that actually happen with sales returns. So we need to be careful in that case. I hope I'm not messing up with your head right now, but it's different, this journal entry, because in here, the return actually happened. And in here, we are just for being careful. And this is the spirit behind that issue of being sustainable and profitable. Because if you do this, if you recognize that you are not controlling everything, that you don't have that, sorry, that you are not, you haven't transferred control of everything, then it is your numbers reflect the real situation, their situation where you still haven't transferred control of these two pair of shoes. So it will be 180, 160, sorry. And this 160, again, as I said, affects negatively accounts receivable. So the other part of this journal entry is that we also need to affect an inventory and the costs of goods sold. The cost of goods sold, as I said earlier, I always like to start in here. Cost of goods sold, it's 40 times 2. But what are we going to do here? Are we going to affect the inventory? Well, again, it's a bit different to the actual return, because in the return that actually happens, you have the inventory in your hand. But in here, what you will register, it's something that we call estimated inventory return. It's also it's similar to the inventory, it's an asset, but it's an estimation. So you are, again, if we go to the financial statement, it will look like this: inventory, then you have inventory of return goods, then you have the estimated inventory return on return goods of return. So all of these are positive, right? Because this is inventory that you have, is just that it's different than the normal inventory because it's of a return good. And in here, you don't even have it. It is the estimation of the inventory that you might receive or not. So this is an example of how accounting has changed, because before the change in 2018, and probably you learn it like that, you wouldn't make this first. You wouldn't make this thing. The best thing that you would have created was an allowance, a provision. But now it's different. Now you have to cancel the sale. You have to cancel the sale in here. You have to affect the cost of goods sold. And then you also have to do this to register the allowance and to register the estimation of the inventory return of return goods, but to show that you are doing that. And it's different to this one because in here it happened and in here it didn't happen. If you learn accounting, or if you learn to account for this before 2018, and then maybe you are not familiar with this, but now it has changed and a lot of things have changed. So now this is one example, this is one practical exercise of that idea of transferring control. But now we are going to do another exercise of another interesting thing. So this is the first one. I will finish the video here and I will start with the second.